Ever wondered if there's like a secret handshake to becoming financially free? Or maybe some magic formula to make all those money worries just disappear?
Yeah.
Well, welcome to Book Talk Finance. So where we try to cut through all the noise and get straight to the wisdom. Today, we're going on a bit of a journey through some really powerful financial books, the ones you probably need to read. We're talking timeless advice, practical strategies, stuff designed to really transform your relationship with money. Our mission, really, is to explore the key insights from these works, give you a shortcut to being well-informed, and hopefully spark some of those aha moments about finance.
It's amazing, isn't it, how much solid wisdom is packed into these books. We're going to distill that core stuff, figure out what makes them so impactful and how the principles could actually change your financial path, often in ways you might not expect.
Okay, awesome. Let's dive in. First up, a real cornerstone, The Intelligent Investor by Benjamin Graham. Legendary stuff. Warren Buffett's mentor, right?
Right.
And pretty much the definitive guide to value investing.
Absolutely. And a key takeaway from Graham, maybe the biggest one, is his point that a true investor doesn't lose money just because a stock price drops. That's not the real loss, the real risk. Well, it's selling at a loss, sure, or if the company actually gets worse, or, and this is critical, paying way too much for the stock in the first place compared to what it's fundamentally worth.
That's such a huge distinction. It really flips how most people react to the market going up and down, doesn't it?
Totally. It means most of the daily market chatter. It's just noise. Your enemy isn't a dip, it's panic. Or overpaying.
Okay, and Graham also talks about Mr. Market. Can you unpack that? Who is this guy?
Yeah, Mr. Market. Think of him as your business partner, but he's really emotional, kind of irrational. Every day he shows up and offers to buy your shares or sell you his, but his mood swings are wild. Sometimes he's super depressed and offers you a great deal. Sometimes he's euphoric and wants to pay way too much.
Huh.
And the aha moment is realizing you don't have to trade with him. You can just ignore him when he's being crazy. You only engage when his rationality actually creates an opportunity for you.
So discipline is your shield against Mr. Market's moods.
Yeah.
Got it. And speaking of discipline, Graham really emphasizes financial strength in companies. What should we look for there? What gives a company staying power?
He looks for a really strong financial cushion. Basically, check if their current assets, like cash and stuff they can sell quickly, are at least double their current liabilities, their short-term bills, and also that their long-term debt isn't more than their working capital. That shows real resilience. They can weather storms.
Right, a solid foundation. Okay, let's shift gears a bit from Graham's very disciplined value approach to something that really challenges conventional thinking. Rich Dad, Poor Dad by Robert Kiyosaki. This one contrasts his two dads, one highly educated but financially struggling, the other less formally educated but wealthy. It really pushes you to make money work for you.
Yeah, and a really powerful idea from Kiyosaki is about the questions you ask yourself. He contrasts, I can't afford it, which he says just shuts down your brain.
Right. End of story.
Exactly. Versus, how can I afford it? Which forces your brain to actually think, to problem solve. That shift in mindset, that simple question, is foundational to his whole philosophy. It's about opening possibilities, not closing them.
That's a simple but kind of profound shift. He also says that just making more money often doesn't fix things, right? It can even make underlying problems worse.
Precisely. More money can just amplify bad habits. If you haven't fixed the underlying issues, a windfall might just disappear, leaving you right back where you started. It's about your internal financial thermostat, you could say.
Huh. And he introduces the Cashflow Quadrant, ESBI.
Right. Employee, self-employed, business owner, and investor. His point is that real financial freedom, and often better tax situations, comes from moving from the left side, E&S, to the right side, B&I, owning systems and having your money work for you, rather than trading your time directly for money.
Which ties into his controversial point about a house, sometimes being a liability.
Yeah, that always gets people talking. He argues if it doesn't put money in your pocket but actually costs you money every month, mortgage, taxes, upkeep, then in a strict financial sense, it's a liability, not an asset. It forces you to really question that common wisdom. Is it making you richer or just costing you?
Interesting perspective. Okay, next up, The Millionaire Next Door by Thomas Stanley and William Danko. This one's based on actual research into American millionaires, and it kind of shatters some myths.
Oh, definitely. The biggest aha for me in that book was that something like 80% of millionaires in the U.S. are first-generation rich. They didn't inherit it, they built it. Slowly, steadily.
So not lottery winners or tech billionaires necessarily.
Not usually, no. They're often living surprisingly frugally. You wouldn't necessarily guess they're millionaires. I think the book mentions the typical millionaire they studied had never spent more than, what, $400 on a suit? Something like that.
Wow. That's not the image most people have.
Exactly. It's not about flashy spending. They tend to value financial security and maybe close family ties more than conspicuous consumption. It makes you ask, who are you spending to impress?
Good question. They also talk about UEWs and POMAS.
Right. Under accumulators of wealth and prodigious accumulators of wealth, it highlights that high income doesn't automatically mean high net worth. You can earn a lot and spend it all, being a UAW. Or you can earn a decent income, but save and invest diligently and become a PA. Discipline matters more than just the paycheck size.
It's what you keep and grow. Okay, let's move to Your Money or Your Life by Vicky Robin and Joe Dominguez. This one feels different, more philosophical almost. It's about reframing money as life energy.
It's transformative, yeah. The core idea is simple but profound. Money is just something you trade your life energy, your time, your finite hours on Earth for. When you start thinking like that, asking, how many hours of my life does this thing cost? Wow. It changes how you see every purchase.
That's a heavy thought. Suddenly that fancy coffee isn't just $5. It's what, maybe 15 minutes of your life you traded for it.
Exactly. It challenges that whole more is better consumer culture. They push you towards finding enough. You know, that Goldilocks point where you have what you need for fulfillment, but without the excess, the clutter, the stress of constantly wanting more.
Finding enough. That's a powerful concept in itself. How do they suggest you get there?
Well, a big part is tracking everything. Every single penny coming in and going out. Not budgeting necessarily, but just gaining total awareness. No more assumptions about where your money goes. You see the reality. It stops you from being, penny wise and pound foolish.
Seeing the reality, including those hidden costs of working.
Oh, yeah. Commuting time and cost, work clothes, lunches out, maybe that extra drink you need to de-stress after work. When you calculate your real hourly wage after all that, it can be a shocker. Your job might be costing you way more life energy than you think.
And then they have you ask that key question.
Is this spending of my life energy aligned with my values and purpose? That constant check-in. It keeps your spending honest, keeps it aligned with what actually matters to you.
Deep stuff. Okay, now for something that bridges the gap between behavior and finance explicitly. The Psychology of Money by Morgan Housel. He really focuses on how our biases and behaviors drive financial decisions, maybe more than formulas.
Totally. And one key insight is what he calls the newbie factor. We all kind of struggle with saving and investing because historically, mass participation is pretty new. We haven't had generations to build up ingrained societal wisdom about student loans or 401k, so we're all kind of learning as we go. It's a good reminder to be a bit kinder to ourselves about mistakes.
That makes a lot of sense. We're figuring it out in real time. Housel also talks about that thin line between bold and reckless, right? And how luck plays a role.
Yeah, he points out that outcomes aren't always just about good decisions. Sometimes good decisions have bad outcomes because of bad luck and vice versa. He uses Benjamin Graham's huge win with Geico as an example. Graham actually broke his own diversification rules there. Part of that success was just luck, the aha, there is. Don't bet everything. The world isn't always predictable or fair. You need room for error.
Room for error?
Yeah.
Plan for the plan not to work out.
Exactly. Which ties into saving. The biggest risk is having zero savings for the unexpected stuff. The field mice, he calls them. You need savings not just for the big goals like a house or retirement, but for the totally unpredictable things life throws at you.
Okay, so behavior and mindset are key. This feels like a good point to bring in A Random Walk Down Wall Street by Burton Malkiel. He takes a different tack, focusing more on market efficiency.
Right. Malkiel's classic argument for the efficient market hypothesis. The core idea, and it's a big aha for many investors, is that stock prices basically reflect all known information almost instantly, which means trying to consistently beat the market by picking stocks or timing your trades is, well, really, really hard, maybe impossible over the long run.
So if you can't reliably beat the market, what's the takeaway?
His big push is towards low-cost diversified index funds. Just buy the whole market. Since picking winners is so tough, maybe even futile, he has that famous analogy about a blindfolded monkey throwing darts at stock listings.
Oh, yeah, I've heard that one.
Doing potentially as well as the experts. So his advice is, own a slice of everything through an index fund and keep your costs super low. Forget trying to be smarter than everyone else.
Simple. Passive investing. Okay, stepping back from modern markets to ancient wisdom. The Richest Man in Babylon by George S. Clason. This one uses parables, right?
Yeah, simple stories set in ancient Babylon, but the lessons are timeless. The absolute cornerstone is pay yourself first. Arkad, the main character, stresses this. Set aside at least a tenth of everything you earn for yourself before you pay anyone else.
It seems so simple, but hard for people to do.
It is. But the insight is that saving isn't about deprivation, it's about building your future freedom. Automating it, like we do now with direct deposits, makes it way easier to stick to. He also stresses being prepared. Opportunity is a haughty goddess who wastes no time with those who are unprepared. You need a plan and consistency.
And protecting your money, too, only investing it safely.
Right. Invest only where your principal is safe, where you can get it back, and where you'll get a fair return. And seek advice from wise people, not just anyone. And conquer procrastination. It's the enemy of getting ahead.
Good advice. Now let's talk mindset again with Think and Grow Rich by Napoleon Hill. This one's huge in the personal development space, too. Based on research with guys like Andrew Carnegie.
Yep. Hill's central idea is summed up as thoughts are things. He argues that your thoughts, especially when combined with a definite purpose, persistence, and a real burning desire, can actually be transmuted into wealth. The aha is that your mindset isn't just fluff, it's an active ingredient in achievement.
A burning desire. He tells that story about Edwin Barnes wanting to work with Edison, right? Showed up looking broke, but just wouldn't leave.
Exactly. That unwavering desire was his key asset. The book outlines 13 steps, a whole philosophy for achieving goals. And a big part is the mastermind principle.
Ah, yes. Tell us about that.
It's about synergy. Hill saw Henry Ford's success, for example, as partly due to his alliances with other great minds like Edison and Firestone. By combining their brainpower and energy directed towards a common goal, they achieved more than any could alone. Two heads, or more, are better than one when they're truly aligned.
Okay, from mindset and masterminds to very practical steps. Let's touch on the Total Money Makeover by Dave Ramsey. He's got a very specific plan.
Oh, very specific. Ramsey is all about getting out of debt and living below your means. His plan is the baby steps. Step 1 is critical. Save $1,000 fast for a starter emergency fund. Just to stop the bleeding, stop using credit cards for every little surprise.
Small buffer, right.
Exactly. Then comes his most famous, maybe most controversial step, the debt snowball. You list your debts smallest to largest, ignore the interest rates for a moment, and attack the smallest one with everything you've got. Once it's gone, you take that payment and add it to the payment for the next smallest debt.
But mathematically, shouldn't you pay the highest interest rate first?
Mathematically, yes. That's the debt avalanche. But Ramsey argues, and this is the aha, that personal finance is mostly about behavior, not math. Getting quick wins by knocking out small debts builds momentum and keeps you motivated. It's psychological. He says it's like 80% behavior, 20% head knowledge.
Interesting. Behavior over spreadsheets. Okay, and that brings us nicely to our last book, which also champions simplicity. The Simple Path to Wealth by J.L. Collins. He wrote it for his daughter.
Yeah, which makes it incredibly clear and straightforward. Collins hammers home that investing doesn't need to be complicated. Simple is better. That's his mantra. He completely debunks the idea that complex strategies or paying high fees gets you better results. Often, it's the opposite.
And like Malkiel, he's a big fan of
Index funds. Specifically, low-cost, broad market index funds. He argues convincingly that trying to pick stocks or time the market is a loser's game for most people. Even Warren Buffett, maybe the best stock picker ever, recommends index funds for most people, including in his own will for his wife. That says a lot.
Yeah, Buffett too. Collins is also pretty harsh on debt, isn't he?
Oh, yeah. He calls it a vicious destroyer of wealth building. His advice is blunt. Get rid of it, especially high-interest debt. Live on less than you make. And save aggressively. He talks about high savings rates, like 50% or more, being achievable and the fastest path to financial independence, or FU money, as he famously calls it.
FU money. Love that. What about market crashes? What's his advice then?
His advice is memorable. Toughen up, cupcake. Seriously. He says market crashes are normal, expected parts of the journey. The market goes up over time, relentlessly. Panicking and selling during a crash is the worst thing you can do. You have to have the emotional discipline to stay the course, maybe even buy more when things look bleak.
Toughen up. Got it. Wow, okay. That's quite a tour through some heavyweight financial thinking. From value investing fundamentals with Graham to mindset shifts with Kiyosaki and Hill, the surprising habits of millionaires, thinking about life energy, our own psychology, market efficiency, ancient wisdom, practical debt plans, and finally, radical simplicity.
It really covers a lot of ground, doesn't it? Each book offers such valuable, actionable insights for anyone wanting to get a better handle on their money.
Absolutely. So if you enjoyed this book talk, definitely subscribe to the deep dive. We do more talks like this, unpacking key insights from important sources to empower you with knowledge.
We really try to dig into the nuggets that matter.
So as you think about all these powerful ideas we've discussed, maybe chew on a couple of questions.
Yeah, like given these timeless principles, what old financial rules or habits might you be holding on to that are actually holding you back right now?
Ooh, good one. And maybe the most critical question for today.
Hmm.
What really makes one of these books, or any financial book, worth reading cover to cover versus just, getting the key points like we did today? What's the extra value in the full experience?
Something to think about. Explore it. And we'll catch you on the next deep dive into what truly matters.